Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone, and welcome to MacroEdge Radio. This is John Galt speaking with a very special program. We have brought the entire last 3 months of this show with some heavy hitters to sit there and talk about macro, equities, bond markets, you name it. This will continue as long as we have the listeners supporting this program. A reminder, macroedge.net/ozone, macroedge.net/ozone to get your 2-week free trial. This is how we share the information that a lot in the mainstream do not want to sit there and share with you. And I'll be quite honest, it is amazing how few people want to talk about this or share it or even discuss what is happening under the surface. Tonight, we have a very special guest. I'll start with the movie analogy first because a lot of people don't have a sense of humor. Our guest, Michael Green, does have a sense of humor. And if you don't know who Vizzini is, one, it means you're culturally unsound. It also means that you're not aware of one of the great classic movies of all time. The Princess Bride is one of the funniest movies ever made. But the one line that's going to cover up our entire economic discussion from that movie, repeated over and over again, is inconceivable. And things that we're witnessing in the economy, in stock markets, bond markets, and government is inconceivable. Without further ado, Michael Green, welcome to MacroEdge Radio. And it didn't activate your thing. Let's try this again. This is the craziness of X Spaces and live radio, folks. We're going to try this one more time. Sometimes there's a lag, and unfortunately, we're all victims of this until Moonbase Alpha is opened and we can actually sit there and communicate normally. Whatever happens, it will sit there and eventually allow him to speak. We've approved him twice. Unfortunately, Elon's blocking us. Michael, you there?
I am, yeah.
Welcome aboard, sir, and welcome to MacroEdge Radio. Please.
Pleasure to be here. Thank you for having me.
Very good to have you. Well, let's start with what we've seen lately in the last 90 days, which is actually quite inconceivable. And unfortunately, a lot of people don't know who Vizzini is, but we'll talk about that another time. Please fill in everybody your initial 35,000-foot overview of what we've watched between the trade war markets and everything else. It does seem like we're in uncharted territory, especially with the government shutdown now starting to kick into quote-unquote economic impact.
Well, I mean, look, what you're obviously referring to are the dynamics that I've highlighted for close to a decade now, which is the growing importance of the passive bid or the behavior of passive investing on markets. I assume that's what you're referencing, that the market's continuing to levitate despite the fact that all indications are this should be catastrophic for the economy. Is that correct?
You're absolutely reading into it correctly, because the passive investing theme, where over 50% of all investing now is passive, does seem to be attracting a risk factor which no one's taking into account.
Yeah, I think unfortunately that's correct. And, the mechanics of how that works, you actually used exactly the right phrase for it, right? The passive factor. In the same way we think about the value factor or the momentum factor, what we're describing is the impact that occurs when an index fund like a total market index or an S&P 500, when that receives the regular flows, not a totally discretionary flow, right? If I decide because it's Tuesday, I'm going to go buy the S&P 500, that has an impact, but it's nowhere near as big as the overall continuous impact of just every single day American retirement funds are being plowed into passive vehicles. That creates a compounding passive effect that is very similar to how we would think about the additional return that you might generate for value stocks or for momentum stocks, et cetera. And the numbers on that are quite shocking. I mean, this is some of the most recent work that I've actually been doing, trying to actually break it down into the individual stock security level, which is very quickly, it looks like something like 25% a year is, in terms of additional return, is currently accruing to a stock like Apple, that's one of the largest companies in the indices. That's happening for two reasons. One is just the mechanical buying, right? So these are not passive vehicles, which means that you never transact. That's the definition of passive in the academic literature. These are systematic strategies in which you give them cash and they engage in very predictable behavior. And there's two vectors that really matter. One is, what is the size of the stock in the index? Because that's ultimately determining how much money is actually flowing into that stock. If I put $1,000 order to buy the Vanguard Total Market Index, somewhere in the neighborhood of $80 is currently going to flow into NVIDIA. It's about 72. And basically, 1/100th of a penny is going to go into Delta Airlines. So it has far less impact on Delta Airlines than it does on a company like NVIDIA or Apple or others. And that, unfortunately, is what we're seeing, is that feedback loop continues. We're seeing the largest stocks continue to get more impulse than the smaller stocks. That's driving the divergence in equal weight versus market cap weight. It's driving the divergence in small versus large. Within small, it's driving the divergences, causing the largest, most speculative, most highly volatile stocks within the Russell to receive a larger impact than the smaller stocks or the less volatile stocks. And so, the description for the S&P is the giants continue to rise. The description for the Russell 2000 is something along the lines of shit floats. Did I lose you guys?
No, we're perfectly in on this. I thought you had more to say, but I was going to just say. So, does that not introduce Talib's theory that increases the risk of the quote unquote improbable risk of events which could have adverse effect on such passive funds? Because if I were going to gamble, I get a 1 in 100 shot of hitting it. Well, that's worth a small wager, just like it is betting on the 000 on roulette or doubling down on 12 like an idiot in blackjack. There is some risk reward involved in going against that theory, because at some point those smaller stocks will overwhelm what's happening to the index funds as they deteriorate, which we're witnessing right now. The performance of everything outside of the Mag 7 is severely degrading as we speak.
Well, so what you're identifying and what's occurring there is actually a very, very specific phenomenon, right? So let's just imagine there's only two stocks in an index, right? A stock that is 50% of the index, or sorry, a stock that is 70% of an index and a stock that is 30% of the index, right? If I put in $1,000 buy order, it's going to send $700 to the larger stock. It's going to send $300 to the smaller stock. If the liquidity in those stocks was directly proportional to their market capitalizations, there would be no impact. But what we know is that liquidity doesn't scale with market capitalization. It scales with volume traded and the volatility of the stock. And so if that largest stock, let's use again the example of Apple, right? It's 100 times larger than Delta Airlines, but the actual liquidity, the dollar trading volume, and the bid-ask spreads and the relatively low volatility means that it's actually getting impacted significantly more than Delta Airlines. To put it in absolute terms, it's about a 0.16% daily move that we're seeing for a stock like Apple, and a 0.07% daily move for Delta Airlines. Both of those are positive. Both are inflationary to valuations. But 0.25 or 0.16 is a heck of a lot bigger than 0.07 if I compound that every single day. And so the next day, right, another $1,000 order is going to buy slightly more Apple and slightly less of the smaller stock. And that's going to compound over and over and over and over again. And that's really what we're actually seeing in the markets. It's not thoughtfulness that's being applied to it. It's not an analysis that says, hey, Apple's just that much better of a company. It's just the mechanical mismatch between market capitalization and liquidity that's really playing through in this game.
So I'm going to cite some forward price earning ratios that have been published, courtesy of Patient Investor on X. Apple 35 times forward P's, Nvidia 34, Microsoft 34, Amazon 33, Google 29, Meta 23, and falling daily. And of course, Tesla with an absurd 204. This is no longer a practical analysis of future performance. It's more so being generated by what you're talking about, mechanical activity until the liquidity dries up.
Yeah, I think that's correct. And I would just emphasize, like, just think about what you just said, right? Apple at 35 times earnings forward, which I don't actually believe, but and Nvidia at 34 times forward. Nvidia has quintupled in size in the past few years. Everybody fully acknowledges that Nvidia has an unbelievable shot at becoming the world's most important company by a wide margin. Apple hasn't grown earnings in 5 years. Why in the world are they trading at the same valuations? Or anywhere close?
Apple's buying more stock back to jack their ratios higher when, like you said, it's a global company. There's global index purchasing of that stock. Does not, outside of the United States, purchasing these companies have a major influence? I mean, who in our lifetime, Michael, did you ever imagine a central bank buying Apple stock?
Well, I mean, it's occurred in my lifetime for an extended period of time, right? Anytime you have a sovereign wealth fund, it's going to occur. You'll have variants of that type of behavior, but so like that sort of stuff doesn't surprise me all that much. We just call that nationalization, right? The British government bought all sorts of stuff in the 1970s. It didn't do it in a cash outlay form. It just said that's ours, right? This is not all that different. It's the actual central banks buying this stuff is really much more a reflection, at least in my view, of the reality that the only path that we actually have towards a bailout is to spend money on the side of the government. And so, whether that's Switzerland or whether that's Saudi Arabia buying it for their sovereign wealth fund, it really doesn't surprise me all that much.
Well, I'm going to jump back to the United States and that thing. It does appear that Trump has adopted, and a lot of people will argue with me about this, but just based on his current actions, the Alfredo Rocco model of corporatism. And no, I'm not comparing Trump to Mussolini, but the theory is a state corporate cooperative arrangement where people can sit there and sell their shares to the government, which would in turn be the same as the company, and they share power. Although the government doesn't manage the day-to-day affairs, they are invested in these corporations to guarantee a certain base and also picking winners and losers. I find that objectionable from a pure capitalist point of view, but in your opinion, does that not raise the risk factor somewhat?
Oh, I think it absolutely raises the risk factor. It becomes a question, at least to me, it becomes a question of, is Trump doing it in a thoughtful way? Is his taking an interest for the U.S. government in the position in Intel? Is that being done for nefarious purposes, or is it being done for national security purposes, right? Has Intel effectively come to them hat in hand and said, we need your help? I don't like that. I would prefer to see a much larger role for the private sector in terms of allowing companies to rise and fail on their own. But the entire process that we're actually talking about here with the passive dynamic was actually put in place by the government in 2006 with the Pension Protection Act. So, we've been told the only companies we can buy are passively held index companies or passive indices in our retirement accounts, at least as the default investments. I guess I'm just not that surprised that the U.S. government is exploiting its position. What I would prefer to see them do, and Warren Mosler, I think, has said this best: taxes are just the government's way of asserting ownership on something. If what you really want to do is you want to own something, then you own all of them effectively by just raising corporate taxes. That's what I would argue Trump should be doing, but he's not particularly disciplined, shall we say.
I find your analysis interesting because it comes back to the other aspect of this where we seem to have become somewhat lax in the enforcement of corporate governance, not just under Trump. And I'm not highlighting him because I'm not I'm not an anti-Trumper, but I'm also sitting here looking at it from the perspective that since the great financial crisis, for lack of a better term, we've let a lot of things go, which in the past you and I might have considered unacceptable behavior, but we seem to have turned a blind eye to questionable accounting practices, questionable insider behavior. And that is another risk factor I do not believe that anyone, especially new investors, are taking into account.
Well, so that part I actually, unfortunately, completely agree with you on, but I'd extend it even more broadly, right? Which is that we have largely failed in any form of economic education, starting in high school when it should really begin. It should actually probably begin even earlier than that. The idea of any sort of principled approach has largely been thrown out the window. And, a perfect example, I wrote an extensive piece on the H-1B visa, right? I actually support the idea of raising the fees on H-1Bs significantly. But the way I would prefer to see it done is to actually use pricing tools to determine what value you should offer them at, right? We know to do this with cellular auctions, that we conduct reverse Dutch auctions that allow for a clearing price and a fair shared price across multiple parties. The same thing could be done with H-1B visas, in which corporations are told, hey, you should bid to tell us how valuable this shortage of workers is in the United States. Establish a clearing price. Those are collected effectively as a form of taxation, and then redistribute those taxes in order to stimulate domestic growth in the labor force in those areas. If it turns out we need a whole bunch of call center operators, we should be offering scholarships for people that major in call center studies. Right? We have the tools available to us. We know how to use finance. We just are choosing not to because we, candidly, I think, prefer to be, governed by what is most entertaining at this point.
That's a very dangerous prospect when you consider that, because as you said, if we were to put the H-1B visas up for auction, we would truly find a base valuation for that labor. As it sits now, it's who can import the largest number of cheap qualified individuals versus the most qualified and beneficial to our corporations and society.
Yeah, I would actually say it's even slightly worse than that. What we have right now is a system that is largely dominated by companies that have institutionalized the process. It was actually done under the first Trump administration. We changed the rules so that instead of having to apply after you had completed the package, which is, by the way, prima facie evidence that you actually care enough to go through the entire process of identifying the worker, identifying, spending the money on the legal documents being filled out, et cetera. That's a positive signal. Under the first Trump administration, we changed it to you simply had to pay an application fee, basically a $50 application fee, to participate in the auction. And then after you won the spot in the auction, you had to pay the legal costs associated with the immigration. What that actually did was bias it towards firms that had institutionalized the approval processes, primarily the Indian consulting companies like Cognizant and Wipro, et cetera. And so they just, they lowered the cost of the application process by institutionalizing it. That allowed them to make far more entries into the lottery than anyone else did, and really has determined the pattern that this has followed. That's just wholesale dispensing with the actual thought process that you should be engaged with, which is really sad to watch.
It is a shame because I've documented this with prior guests about the problems that started in the 90s and have simply accelerated and furballed to this time. Moving back into the equity market, Does that not, if you're able to sit there and obtain that labor for a lower price, that obviously gives your company, for example, XYZ Corporation, a competitive advantage with one, government backing, two, the ability to bring H-1Bs at a lower cost. We're witnessing a washout in the transportation industry because of the ultra high capacity inflated by, let's face it, non-domiciled CDL holders. I don't know if you're following that. That's just part of my background. Apparently, we spread this out over numerous industries thinking it would solve a labor problem that was either A, non-existent, or refusing to improve efficiency in our industries and manufacturing processes. Is that out of, does the same theory apply to high tech, in your opinion?
It absolutely does, because what you would actually see, right, that lack of necessary efficiency, that tells you companies are not competing at a marginal revenue, marginal cost basis. They're competing on an average total cost. In other words, that's what a monopoly is. And so by and large, that's what we have allowed to occur in the United States, is we've allowed a series of monopolies to emerge, where a company like Microsoft, for example, just announced a 35% price increase on Microsoft Office, which has seen no tangible innovation or rational reason for a price increase in the past 15 years, right? But they have the ability to say, we're going to increase the price of this. What am I going to do? Switch over to Google? Right? That's barely getting any support anymore. And by the way, is that really going to solve a problem for me? From a professional standpoint, you actually need these products. And so exploiting that is prima facie evidence of a monopoly, which should be opposed by the FTC, but we have failed to enforce monopoly behavior for going on 40 years now.
Well, we'll get into the discussion about the FTC and regulatory enforcement here later in the program, because I think what we're witnessing with the government shutdown is also evidence of how disconnected our society is between the so-called government, those who have financial interest within the government, and the rest of society. I'm a firm believer in the K-shaped economy theory, although there are others advocating for the I-shaped. That's another subject entirely. But I'd like to bring Six on, who's one of our equity traders, who's part of the MacroEdge team, Michael, if you don't mind, and have him ask a few questions of you, because the way the market is behaving right now with the deterioration in breadth and other aspects, and I'm more of the gold, silver, metals kind of guy in this big picture and logistics. Michael he is more of a broader picture, treasuries, etc. Six, please take it away.
Hey, Michael. First of all, a couple things. I want to, first of all, apologize. My kids are probably in the background. They're hopped up on candy, as could be expected at this time of year. Second of all, I want you to know that I have the utmost respect for you.
This sounds imposing.
Can you hear me?
Yeah, I can hear you just fine. Anytime somebody leads with a compliment, I know what's about to come next, which is
No. All I was gonna say is that in terms of my primary job, we have close to 9 figures invested in Simplify's funds, namely concentrated in HEQT and CTA. So I mean, I have the utmost respect for you, and I just wanted to lead off with that. But
well,
I guess
I appreciate that very, very, very much. Thank you for the vote of confidence.
Absolutely. I think you're doing a great job. But anyway, I guess my main question would be, outside of, I guess, like historical, statistical things, like, we could probably expect things like energy and small caps to outperform going forward, like beyond the index level. I guess my main question for you would be, where do you see value moving forward in all asset classes, I guess?
Well, unfortunately, I see a lot less of it right now. But what I had been highlighting to people was particularly at the long end of the curve. So the way I think about passive is twofold. One is you can either join the party, right? In which case you have to just be very thoughtful and aware of what you're doing. And candidly, I've just recently had some breakthroughs that allow me to start to do that in a very detailed way. I'm sure somebody at Susquehanna has figured this out long ago. But if you're thinking in the macro sense, the assets that you want to look for are the assets that are ignored by this passive phenomenon. A good example would have been gold, right? Gold does not have a role in target date funds. We've seen the passive bid emerge in the GLD and in the GDX now. Those have started to turn up in terms of the shares outstanding and the flows, and that's telling you that retail was very late to that party. But you can actually see the impact of their flows there. I've posted several times the same thing for Bitcoin, et cetera. Where it gets kind of interesting is within the indices. So if you think about that example that I just gave of the 70-30, if you play that forward over time, the 70 gets larger, the 30 gets smaller. And so eventually there's an element of neglect that hits the smallest companies in the indices. We're starting to see that. It, again, remains a positive impulse, but it is less and less so. Eventually you get down to the size where you're so small that the passive largely ignores you, which I'd argue is starting to happen in the small cap space, but we're still a long way away from it being that clear. Where I thought it was more interesting is if you think about the mechanics of a market cap weighted bond index, it actually has a really surprising impact there. And bonds have a unique characteristic to them. They have endogenous liquidity where they will ultimately return the cash that is embedded in the current pricing regardless. Right, so if I buy a bond at par and it's yielding 5%, then I'm going to get 5% if I hold it to maturity. If I buy a bond that has a 2% yield and it's trading at par, it's going to yield 2% to maturity. If you just imagine again that same example, let's say we just have two bonds, a 2-year bond and a 30-year bond in the index. They're both 50-50 in the index currently. The Federal Reserve lowers interest rates. What happens to the price of the 2-year bond? It doesn't move very much at all. What happens to the price of the 30-year bond? It goes up a lot. Now, if I look at the index on a market cap weighted basis, I'm overweight 30 years and I'm underweight 2 years relative to their notional quantities that are outstanding, but I am in their face values, but I am in proportion to the market cap. That means more of the next dollar that's going to come in chases the 30-year bond. This is one of the reasons we had such extraordinary duration exposure in the indices as we went through the series of Fed rate cuts. It meant that duration was heavily overweighted in the bond indices, and it's one of the reasons why the duration performed so poorly in this cycle. But now we're at the other end of the extreme, right? The Fed has hiked interest rates. What happens to the 2-year bond? Not very much. What happens to the 30-year bond? It falls a lot in price, right? And as a result, it has shrunk in its representation. And so the long end of the curve was experiencing extraordinary levels of neglect that were the cause of all the narratives that, you know, we're losing control of the long end and, oh, we're going to have our Liz Truss moment, et cetera. Like, if there was ever a Liz Truss moment, it's when you're not actually running, you know, your government is not operating. How crazy is that? And nobody cares, right? Nobody cares.
Yeah, that's a very interesting point. And it certainly hasn't come yet. I guess my next question would be, in a market that is so infatuated with trading and what's the next trade, how is an investor at these price levels across all asset classes supposed to think about where their next marginal dollar should go with indices so heavily concentrated in Mag 7 and bonds already kind of at the lower the curve is not very attractive, at least to me. On any point in the curve, I'm not very attracted to any point. The 2 years were attractive a while ago, not so much now. How do you think an investor should think about where their next dollar should go with pricing as it is across asset classes? I know that's a hard one. I know that's a really.
I mean, look, there is an element of this is just an everything bubble at this point, right? And are there areas that have experienced neglect? I would argue that oil is now cheap, for example, right? There is no natural passive bid for any of the commodities. Gold is a ticker within portfolios that makes it easier for people to chase gold than it is to chase oil, for example. But across the financial asset space, there's just not much, right? I mean, you see me say this all the time. People will complain about, small caps are experiencing neglect. They are relatively cheap versus large cap, but they also are much lower quality, and they also are very expensive versus their own history. And so, one of the key things that I highlighted in 22, if you remember, like everyone was basically saying, oh, look, now we have real interest rates. That means that growth companies are going to, be less richly valued than they were in the past. Therefore, value should have a chance. The simple reality is value is just another way of saying anti-momentum. And so you've effectively ended up with a situation in which, you cannot work until this stops. You can work episodically, but not in any meaningful way.
Six, let me hop in here real quick because I've got a question for Michael. He brought up the financials, and this is a question that's going to be for our friend Melody and several others. We're starting to see some deterioration on the fringes due to private equity, commercial real estate, and non-conforming MBS being held by regional and community banks. Is there not a division within the financials between the larger and large cap financials and the smaller community, et cetera? I do believe there is a higher risk factor only because not an 07-08 scenario, but just because of the lack of regulatory enforcement and paying attention to the monies being diverted to NFBIs.
Well, the reason the money is being diverted to the NFDIs, the non-depository financial institutions, is because there is, of course, a regulatory arbitrage associated with that. If JP Morgan were to lend to a smaller operating company, let's call them First Brands, that would carry a relatively high weight on their capital charge. By lending to a non-depository financial institution, they're able to effectively skirt the lending to the more speculative borrower, and they end up getting a much lower capital charge that allows them to outsource the credit function to the private sector or to the NDFI sector, with the idea being that these people are good at what they're doing, right? And what we're discovering is anytime you send a ton of money to people and tell them to put it to work, they're not very good at it. And that unfortunately is what's playing out in the NDFI space. And NDFI is a broad sector that really didn't exist within classifications until 2018 is when we first started to break it out. But it includes everything from private credit lending to buy now, pay later, to levered ETFs, to private equity lending, et cetera. So these are all, this is an area that has exploded over the past, 7 years or so in terms of its importance to the banking system. But at the end of the day, it's the banking system. It's just they've outsourced their credit function.
So when you see stories like what broke today about a firm selling $750 million in BNPL loans to a life insurance company, New York Life specifically, does that not raise red flags that we're starting to reach the peak of the speculative fervor in the aspect that these are really not solid assets with a high risk of failure, especially if economic deterioration for the lowest 50% of the population continues?
Well, I mean, look, this is the great fiction, right? That, we didn't have to worry about the bottom 50% because the top 50% was doing all of the spending. I don't really know what to say other than obviously that's untrue, because there's an extraordinary amount of consumption that occurs in what can be thought of as the household level or the pantry level, right? People in the bottom 50% own houses, they pay taxes, they buy, they buy staples, they put laundry, they put laundry detergent into their shopping carts, and they put food into their shopping carts. If we drive them out of business, we're going to see a 50% decrease in demand for housing because they will, or 25% decrease in demand for housing because they'll double up. They'll do what people always do, which is they respond to economic incentives. And one of those right now is you can't form an independent household. We're particularly seeing that at the younger end. But it's starting to bleed its way up. And now we're at the point where almost 85% of the population has been left behind in a very tangible and sizable way.
And that does sum up the base of the question, the K-shaped economy, so to speak, with a larger lower leg falling further and faster. Real quick, Michael, promote your website, promote your hedge funds, promote what you do, because we always offer free commercial time to all our guests. I think that's important, that people need to follow you at Professor Plum on X.
Well, yeah. So it's first of all, it's at Prof Plum 99. But PROFPLUM 99. And as you pointed out, I'm an odd-looking bald guy in my avatar. I'm also an odd-looking bald guy in my normal life, but just not as bald and not quite as odd-looking. My Substack is yesIgiveafig.com. There's a modest charge that I charge for that, more because I want to have people actually value what they're reading as compared to just skimming through it and discarding it. And then you can always find our work at simplify.us. There's deep explanations funds we offer and the tools that we use. Simplify was a byproduct of regulatory changes. In 2019, there was what's called the ETF rule, which simplified the process of applying for an ETF or launching an ETF. In 2020, we introduced what's called the derivative rule, which allowed the inclusion of derivative strategies into ETFs. Simplify launched in September of 2020. We were one of the first to target that space. And in general, what we're trying to do is modify some form of a beta exposure. I directly manage our high yield fund. The ticker on that is CDX. That has a unique approach to, accessing the returns associated with the high yield space. And more importantly, actually has some proprietary hedging tools that I've created over the last decade or so, designed to protect against the widening of credit spreads. That's obviously what we're very concerned about in an environment in which we're suddenly discovering that there's probably many cockroaches out there.
And a very logical assumption based on what we're witnessing, not just from a Wall Street perspective, but on the ground, which is more to where I'm at. You see the cockroaches. People just don't want to call them cockroaches. They want to call them opportunities. That's pretty scary. One quick plug for MacroEdge, macroedge.net/ozone, macroedge.net/ozone. Sign up, get your 2-week free trial, and please follow the bald guy, Michael Green. If you haven't seen The Princess Bride, also wake up, get some culture, people. Let's get back to the subject, because you brought up derivatives, and I really think this is a question. I just want to get this stupid, insane, and inane FinTwit X fetish with a chart that circulates every quarter, and with this posting from the BIS, and that is, and you're much more attuned to this than I am. I'm just a simple precious metals guy. The chart about $395 billion in unrealized losses for American banks, and the quote unquote quadrillion in derivatives. I have my own opinion, but I would like some clarity for someone who can blow this out of the water once and for all. It's an overrated clickbait, in my opinion, but please sum it up for our listeners so once and for all they can understand what's really going on.
Yeah, so the losses in the banking system are largely tied to that duration exposure. It's the same underlying phenomenon that we talked about in index construction. If I buy a long-dated bond and interest rates go up, I show mark-to-market losses on that bond. The bond itself is really good. If I hold it to maturity, I'm going to be compensated and earn all of my money back. That's really what is the hold to maturity losses that you're hearing about within the banking system. It is money good asset. They will make their money back. They just need time for it. The Silicon Valley Bank event was not caused by the hold to maturity. There is some contribution coming from it. Once you designate something hold to maturity, you can't sell it to obtain cash. What really happened with Silicon Valley Bank, and I wrote about this extensively in my Substack, it's been blessed by the CIO and former CFO of Silicon Valley Bank as being an accurate analysis of what actually occurred. At the end of the day, what really happened in Silicon Valley Bank was a good old-fashioned bank run where venture capitalists rapidly withdrew their deposit funds. That created a crisis of liquidity, not of solvency at Silicon Valley Bank. Now, the bearish case on Silicon Valley Bank up to that point was not about the hold to maturity losses. It was actually about the low quality of the lending that they had done within the venture capital space. That turns out to be true as well, but they'd largely forgotten something that was really, really critical here. When you had something like the Paycheck Protection Program or the Employee Retention Credits, those were scaled to, we will pay you a portion of your employee costs. The single biggest beneficiary from those strategies are unprofitable companies that spend all of their money on employees, i.e. VC-funded unprofitable startups. And so they actually had an incredible surge of cash that came in the form of deposits in 2020 and 2021 that was further enriched by this SPAC boom and the mini IPO boom that we saw and many of the acquisitions in the 2020 and 2021 time period. That led to a surge in deposits at Silicon Valley Bank that they had to put to work, right? So they went off and they bought longer duration assets, not fully appreciating how unsticky those cash deposits were going to be because the companies were money losing, and not properly anticipating that the IPO market would shut off as well, which cuts off their incremental flow of funds. And so they found themselves short of cash, right? That's what Silicon Valley Bank was all about. We've addressed that problem. The lending programs that the Fed entered into solved the liquidity issues within the banks. It momentarily impaired their profitability, which is part of the reason why none of them did all that well. But we actually have now created another issue, which is simultaneously during the COVID time period, we suspended all types of credit reporting, in particular on student loans, but also on medical debts, also on mortgages, etc. That had the effect of inflating credit scores. And, if you take somebody with a 550 credit score and you suddenly artificially give them a 700 credit score and then lend money to them because they're a 700 credit score, they're still a 550 and they're still going to behave exactly like you would expect a 550 to behave. And they overspent, and now we're dealing with the consequences associated with that.
I think you've just nailed the most crucial point in that discussion as we've moved forward into the period of slowing or continuing economic deterioration. And that is, while the higher class, safer part of the population, that 5 to 20%, whatever number you want to throw a dart at and call it this month, the lower 50% are really struggling at this point in time. And I don't think the recognition by the financial institutions is there, nor private equity. So instead of a run on banks, is a run on hedge funds and private equity, which does have a lot of lockups, present a greater challenge for investors at this time. Because if there is a run on a hedge fund or et cetera, the first thing they're going to sell to raise cash is, well, gold, treasuries, and of course, liquid equities.
Well, and on a super important point, right? So private equity is largely locked up. Liquidity is very difficult to obtain. Those companies, what has happened is the institutional space filled itself up on private equity, venture, etc., seeking higher returns at lower volatility, what Cliff Asness calls volatility laundering, where they are not regularly posting the prices and the returns, and they're able to, quote unquote, mark to model as compared to mark to market. That gave the illusion of stable returns. Against that, they were not increasing their allocations. They were using the cash flow that was generated out of those investments to free up additional investments in new funds. Distributions have absolutely collapsed. They've fallen from about 30% of the assets that were invested in the space, which is, by the way, roughly consistent with what high yield delivers. High yield, on average, in any given year, my fund will return about 20 to 25% of its assets in the form of cash. The fund of maturing bonds and the coupon associated with it. The average life of a high yield bond is about 5 years. There's about a 7% coupon, so that's about 27%. In the case of private credit, or private equity, you have higher multiples of what you're receiving back on what you originally invested. That led to distributions that were about 30% of the investments that were made in any given, that were in existence in any given year, was their historical distribution rate. That's fallen to about 10%, but not enough to meet the liquidity needs that the space requires. And as a result, they've started to crank up the leverage that is used inside the space. Things like portfolio loans, which is a way of adding leverage at the fund level as compared to at the company level, or what are called participation. Oh God, I'm blanking on the name of it. Effectively, they would borrow in the future and use that to actually get funds to pay everybody else, right? Classic Ponzi behavior, layering on debt in term to return capital. But that has largely been exhausted as well now. And so, private equity and private credit and venture capital are all increasing liquidity constrained framework where they can deploy new loans because people will lend money to them, and will invest marginal equity with them, but they really have no path out of their existing investments, which is why you're seeing a big push it into 401ks. It's 401ks are give or take an $8 to $9 billion. If they can get 10% of that, that solves a lot of their problems.
Do you feel that this is
just to put total math behind that, by the way, 401ks are about 9 trillion. IRAs are, I believe, about 21 trillion. So the combined assets in IRAs and 401k are $30 trillion. Almost all of which at this point is, being directed towards passive investment strategies. This is the single largest sovereign wealth fund on the planet, right? It behaves as if there's a single allocator because of the use of default investment strategies. And that's really that passive bid to bring it back full circle.
Well, that brings us full circle to the risk reward ratio, because one, I find that allowing 401k managers and IRA managers to invest in private equity, private credit, one of the most dangerous prospects in decades. We witnessed what happens when you give unrestrained investment a chance after 1998 and LCCM. So let's rewind to what's happening now with the economy. We have an economy that's basically on strike. We have the equity market behaving on its own because there's really no data to guide it, but we have no economic data, or even beforehand for the last decade, accurate, measurable economic data, which has always been in doubt. With the risk of trust being the biggest factor, and this is not a Trump thing, this goes back to the George W. Bush days, we have to start asking the question, at what point in time does accurate factual data matter in the aspects of market concentration, passive investing, and of course, a risk factor due to mismeasurement of economic conditions?
Well, fronts. One, again, I on regular basis an academic paper that was written in 2004 by Michael Jensen called "The Agency Costs of Overvalued Equities." And what he was highlighting is that if a company becomes persistently overvalued, their management begins to engage in behavior that you would expect to be consistent with an improperly specified cost of capital, right? They assume their equity capital is effectively free, and they start to spend an insane amount of money, which is exactly what we're seeing out of the largest companies in the United States today. Without the disciplining effect of valuation in the market and a feedback component that leads these companies to engage in goose chases like Meta chasing after VR or augmented reality or whatever you want to call it. Now Meta's chasing after LLMs, right? The simple reality is Mark Zuckerberg hasn't had a very good idea in roughly 20 years. And you're seeing Meta behave exactly as you would expect. A company run by a guy who hasn't had particularly good ideas for 20 years, has no real understanding of his customer base, et cetera. You kind of appreciate the discipline that Sheryl Sandberg brought when she was there. Now that you see them kind of behaving, doing whatever Mark wants them to do.
Absolutely terrifying. And that brings us to the competition we've been witnessing between the Chinese and the American government. It does seem that the Chinese seem to have acquired or identified a potential edge in this quote unquote AI race. You don't see a massive build out of data centers in China compared to what's happening in America. Is this so-called build out by the American companies, corporations, a bubble, so to speak, as people are calling it, or is it simply something to sit there and churn investors' money and produce returns in the belief that at some point there'll be future returns? I'm going to tell you from my background in this area, by the time most of these data centers are built, the very chips that they had purchased 2 and 3 years prior are going to be generations past and no longer viable. Your take on this, sir?
So I lean in that direction. I don't think that I think it's very easy to assign wisdom to those who are on the other side of stupid behavior. China is just as bound as the United States is. They are forced to engage in all sorts of bad behavior, primarily because they have a system in which they are constrained primarily on demographics, but also on resources. They do not have a lot of oil. They do not have a lot of energy. They do not have a lot of raw materials relative to their population base. They're short food, etc. So they actually don't really have the capacity to build out, regardless of whether we were to look at the chips themselves. And again, the US government, if the US government were talking about spending money this way, we'd be freaking out. But because it's being directed, quote unquote, by the private sector, we assume it all makes sense. That's just as wrong as assuming everything the government does is wrong. Um, we are misspending. My hope is that it will end up being like the fiber build out, ultimately what's called a social bubble or a positive social bubble, in which investments are being made that will prove useful but not economic. And so the build out of railroads and the build out of canals and the build out of roads were not particularly economically valuable for the people who undertook them, but they were very valuable for our society. Framework in which LLM would be, where we are first over the artificial intelligence hump, and we discover, as we are in some ways, I use LLMs every single day, but we may discover that we made investments that are great for society, but just not great for the companies themselves. That's the most positive interpretation you can have about it at this point. One of the great stories I like to remind people of is during the fiber build out, you had internet service providers and telecom companies spending money willy-nilly. I don't know if you've ever heard of a company called Cogent Communications.
I remember them, believe it or not. Then again, I'm old.
So Cogent Communications is ticker CCOI. It's still the founder, Dave Schaefer. Dave Schaefer was the scion of a taxi cab company, right? So his family had started taxi cabs. The unique assets that emerged for old-style taxi dispatchers in the 1990s was what are called trunk radio spectrum. They had a defined spectrum that was used for taxi dispatch that it turned out was very, very valuable for the mobile telecom operators. And so those assets that was sold at a tremendous profit markup. It gave the capital and the awareness of telecom as he saw things falling apart in the ISP and telecom space. He bought the excess spending, and for $1 million bought $1.5 billion of equipment. And for $12,000 a month, leased a single fiber from level 3 locations that he subsequently levered into becoming the largest internet bandwidth provider in the United States. Right, so he literally spent somewhere in the neighborhood of $1 million to become the largest internet service provider in the United States. That changed a little bit with the COVID dynamics. They were primarily focused in commercial office space. But when I was running, my hedge funds back in 2005 to 2016, every single hedge fund had to be in a building that had cogent bandwidth, because it was so much cheaper and it was so much more effective for data intensive businesses. this led to a very good investment for me as well, because I was speaking to them and saying, you know, well, who's your largest customer, trying to understand customer concentration. And they said, well, our largest customer is probably this company called YouTube, which had literally just appeared. And I said, well, all right, well, how much are they spending with you per month? Because the word on the street was that they were losing $500 million a month on their bandwidth to serve video. And the answer was they were spending $50,000 a month. Right? So YouTube was made possible by that collapse in bandwidth costs. I'm excited to see what emerges when we discover that we're ultimately being served ChatGPT in exchange for ads for Team.
I think you've pretty much nailed it right there, because I think the future on the other side of this is excellent, but I think we do have to have a washout of the malinvestment. And that's just one of those things that I think the malinvestment needs to be punished. I think the banks that engaged in malinvestment need to be allowed to fail. I mean, there are some banks that survived the GFC that shouldn't be around today, and they're going to get a pass. And, you know, I'm not the one who makes that judgment. We should let the markets make that judgment. I've got one question for you from a listener, which I think is very, very pertinent to the discussion tonight. Trend and momentum. It seems like commodity trend following and tactical trend momentum type strategies, moving averages and volatility sizing, can fare well in this passive distorted market. What's your take on that, sir?
Wait, could you repeat the question one more time? I apologize.
That's okay, sir. I understand. Believe me, with the connection, sometimes we get through X, it gets dicey. It seems like commodity trend following and tactical trend momentum type strategies, moving averages and volatility sizing, can fare well in this passive distorted market. Your opinion on that?
I think there's some truth to that, but I think it's important to understand that what you're really doing is basically giving yourself the permission to follow along with the dominant trend, right? What is being created by that passive factor. And the nice thing about trend following is that you're not trying to rationalize it, right? You're not saying, oh, I think NVIDIA is the greatest company. Because if NVIDIA falls 20%, you're still going to say, oh, NVIDIA is the greatest company, right? It's when NVIDIA falls 85% that you're like, oh, I hate NVIDIA. I don't ever want to buy it again. Trend following just dispenses with the narrative. It says, I don't know why it's going up, but it's going up, so I'll continue to participate. It's very, very similar. The way I think about trend following is ultimately it's very similar to delta hedging an option, right? As an option goes into the money, you buy more and more delta 1 exposure to offset your position. Trend following effectively engages in that behavior. There's nobody at Susquehanna who's on the other side of your option trade who's saying, gosh, I really disagree with this guy that the stock price of Apple is going higher, and therefore they're taking the other side of the equation. They just want to sell you more. Right? So they're going to it removes what's working. That can work very, very well. Not really well. It's not a time period for trend following strategies. 2020 was not a particularly great time for trend following strategies. They found themselves offside because of the speed of the moves. But broadly speaking, for that center of the move, trend following is great. And we have trend following products. Our product CTA has done extraordinarily well. That is a value added managed futures strategy. There are other ways of approaching it, index strategies, et cetera. But we definitely support that view. The only thing that I would emphasize on things like commodities, et cetera, is remember that many of the signals that we're receiving about economic activity, because we tend to associate that with the VIX or with credit spreads or with the performance of the broad indices, it's not actually telling you anything about the economy. I think most interesting is what's happening to things like oil or even copper in gold terms. They're that the economy is not strong.
Boy, that you just walked into my question, because if I don't ask this on behalf of my fellow gold bugs and silver bugs, it does bring an interesting point of view. A lot of people have viewed gold as an inflation hedge. I call that utter nonsense. It's more of an instability hedge, instability in financial markets and in geopolitical markets. However, when you look at what's happening, as you just discussed, Dr. Copper has not confirmed the decline in gold at this point in time, nor has it confirmed an expansionary move in the U.S. economy. With that in mind, I think more corrective action is forthcoming in the next 2 to 3 months. People disagree with me. I don't care. I have my opinions and I've had them for 20 years. When you look at the big picture, does it not seem logical that we will see some corrective action in base metals and also in the precious metals as we move forward? If that,
I mean, the quick answer is yes. I do think that you will probably see corrective action in the base metals. I am concerned about the potential for a 2020 style downward move in oil. Inventories are high. In floating storage are growing. I don't think we're going to see negative prices again or the sort of extreme shutdown that we saw, but I would expect oil to enter into significant what's called super contango that basically incentivizes the hell out of people to put stuff in storage, which means the back end of the oil curve is probably more at threat than the front end of the oil curve.
I tend to agree with you. My target price is still in the $45 to $50 range, and hopefully it bases there for those who are long oil and pray to God that it bounces back. With that being said, I don't want to abuse our time with you. You've been a fantastic guest. You've answered a lot of great questions. Let's take a big picture look. Assuming that we resolve this government shutdown in the next 30 to 45 days, do you see an emergence of credit risk and economic measurements that reflect the downturn forthcoming in 2026 that will probably be resolved long before the election, but enough to sit there and scare the hell out of investors and maybe bring some sobriety to the markets?
I'd love to believe that's true. If that's going to emerge, the reason those problems tend to emerge from the credit markets is because credit occupies a unique space within the capital structure that has a change of control function. And so that means that when things get particularly distressed, the management team is forced to suddenly start operating the business on behalf of the creditors rather than the equity holders. That tends to create a catalyst. Is that going to be the case this time? I think so, but we are starting real work, but many measures of secondary market security in the credit markets remain tight because there has been relatively little issuance. Interestingly enough, as people have suddenly woken up to the dramatic increase in issuance associated with the hyperscalers, you're starting to see the investment grade bond markets begin to have some skepticism. And so we've seen IG CDS widen out a little bit. We've seen some uncertainty around the new Oracle debt issue, et cetera. Those are the areas that I'm paying very, very attention to right now.
Michael, please promote your website, because my take on this is also like yours. I truly believe that we've adopted the FICO model for a lot of our credit ratings. I believe CCC is the new B, but we'll find out in the months ahead. Please promote your website, promote your stuff again, because we welcome anyone to have these kind of in-depth discussions on MacroEdge, and we would welcome you back again anytime you're ready to come on, sir.
Well, I appreciate that, and thank you very much for having me. Again, Simplify is the website. Product I manage is CDX. My Twitter is Apple99, and my Substack is yesfig.com. I'm happy to give out scholarships or discounted memberships if you're concerned about the cost. The only reason I charge is because I know that people, if something is free, they're going to treat it like that. And candidly, that's a disservice to everybody, especially myself.
Sir, thank you so much. And one more time, folks, inconceivable. Go watch The Princess Bride. You might understand a lot more of this conversation if you pay attention to that. Michael has one of the most distinct avatars on X. And I guarantee you 90% of the people have no clue what it is. Only the cool people get that. Michael Green, thank you so much for being a guest on MacroEdge Radio. For MacroEdge, this is John Galt. Good night, everyone.